Good morning, everyone. Hope everybody navigated all the snow well. We have an intimate crowd, so make sure you guys get credit for being here. I wanted to revisit this from Monday. Holly asked a great question, and I don't feel like I gave the best response to it, so I spent some more time thinking about it. This goes to my point about not trying to memorize rules, but trying to understand the rationale behind rules, because it'll serve you a lot better, this does me, in recalling rules than trying to memorize a bunch of things for that. I'm asking questions, trying to understand why the rule is what it is, because there is rationale behind why Congress and the President have designed the rule the way it is. So if you recall in the housing cost exclusion, this is a multinational with a mobility program where U.S.-based employees would be sent abroad to work in the foreign operations of a U.S. multinational. As part of that, there would typically be a housing cost allowance that the organization will pay the individuals to help alleviate the cost of having to incur housing, likely again in two locations, because a temporary assignment, they may not be giving up their U.S. housing. So the way this is structured is we have to compute the eligible housing expenses, right? So this is how much did you incur for these particular things and are they eligible? Then we reduce that for the base amount. The base amount is not excluded. Okay, so the double negative means it is included. The reason for that is the idea that, remember, anything that, those of you that were in taxation of individuals, anything an employer gives to an employee is compensation to begin with, unless we exclude it. If an employer is paying for housing of some of the individual, that would normally be compensation and be taxable to the employee. So the reason we compute a base amount is this is the government's estimate, and it's indexed for inflation, of what a normal housing expense would be for an individual. And that is $20,800 for this particular year. Okay? So that amount is not eligible for exclusion, it is included. Everything in excess of that is an eligible expense is then excluded from taxable income. And that's kind of, I think where I got caught on Monday is that's counterintuitive. Why is anything incremental to that excluded? I think the best rationale for that is think about all the places you could be sent in the world. There are high cost places to get sent to. Hong Kong, right? New York City. Highest cost places to live in the world, right? Your housings would be very expensive there. The idea is the government is trying to give you some flexibility to accept that position. And that might be driven by the employer offering that to you, not your choice, right? If you're sent to rural Germany, the cost of housing there is vastly different than downtown Hong Kong, right, or downtown Manhattan. So that's where I think they're trying to say, okay, your employer might direct you to a certain location. This is the opportunity, this is where I need you, and your housing cost might explode. That's not your choice. So now you might say, well, isn't that open-ended? Because I could live at the penthouse of the most expensive high-rise in New York City that might be $1 million a year. Well, I think the reason the government doesn't have a governor, if you will, or a cap on it, is because there's natural tension between the employer and the employee, right? Just like your compensation. The employer is looking to pay the least amount possible, right? They're running their business, trying to manage it. So they're not going to just shower an employee with the most lavish lifestyle possible in terms of housing. So that's going to put a natural cap, just the bargaining position of employer and employee to keep that from getting out of hand. Okay? So I think that's the rationale of why that is. A base amount, that's just your employer giving you something to live, your housing, that should be taxable. Anything above that might be because they're sending you to a high-cost location. Why isn't it just like unlimited? Well, the employer is not interested in providing $1 million for rental expense because you choose to live in the most expensive location in the world. Okay? So it'll naturally cap that. So I think that's the way to think about how this is structured and why it's structured. Okay? Holly got a great one. Okay, let's pick back up to the chapter 3 material on sourcing. Okay. So remember, we're trying to get to a net number for various reasons. One is for U.S. persons, which is the foreign tax credit. We have a foreign tax credit limitation. That's this prior slide, this bottom yellow, that middle part. Net foreign source income, key component in computing the foreign tax credit limitation. So I have to source income between U.S. and non-U.S. I have to sort all my expenses between U.S. and non-U.S. That's going to get me my net foreign piece for purpose of this calculation. The way to think about that is I have income items and I have sourcing rules. That's where we're going to spend most of our time today. It will be a slog, okay? Bear with it. We go income item by income item. This is something that I wouldn't necessarily commit to memory. It's one of those things that I mentioned on Monday. If you practice in this area, if you do international tax, you'll become very good at understanding most of the rules. But this is something you might just want to commit to notes. If I was going into a meeting and we were going to roll through the income statement of a company and start sourcing things, I would have all my notes down when I walked into that meeting. So that's the income side. We're going to source those. The good thing is we just have two places to send it. U.S., non-U.S. I don't care what other country it is as long as it's not the U.S. Okay? And we don't send things to outer space, so it's only U.S. or non-U.S. Okay? Expenses, I'm going to apportion those between the same two buckets, foreign and non-U.S. I net the foreign source income piece and the foreign source expense piece. That's my net foreign source income, which is this multiplicand in that calculation. And we know for corporations at 21%. We basically computed the foreign tax credit limitation once we've done this. But the devil's in the details. I got to go item by item. And what's a little scary in this part is if you get the income, right, because it's binary, it's either U.S. or non-U.S., if you get the rule wrong for a particular income item, your calculation's wrong. Foreign tax credit's wrong, right? So that's why it's one of those things you just commit to a note and then make sure you got it exactly right on those things. Okay, so the FTC is limited, remember, so we're going to talk about for U.S. persons for a moment, to ensure that the U.S. preserves its right to fully tax that U.S. source income. Remember that prior example from last week, one of the cases, we had like a -9, I believe, was in there, and that would have forced if I gave too much credit for foreign tax that was in excess of the U.S. tax rate, then what the U.S. is doing is effectively ceding the right to tax U.S. source income to a foreign country. You know anything about our current leadership in Washington, D.C., that would be not something that they would be in favor of, right? They're not going to give up the right to tax U.S. activity to any country. Okay? So the FTC is the limitation that guards against that. In practice, so we have theory on foreign tax credit, and then we have in practice that we're going to start today. The FTC limitation can prevent taxpayers from creating all of the foreign tax they incur. Okay? When the U.S. person's foreign tax is less than their FTC limitation, I have a limitation of 100, but let's say I pay tax of 75, so I can credit all of the 75. I am crediting all of the foreign tax. Right? That's a good place to be. If I can keep that limitation higher than the amount of foreign tax I pay, then I can claim all of the foreign tax I pay. However, when the U.S. person's foreign tax is greater than the FTC limit, they cannot credit all of the foreign tax they incur. That increases their total tax burden beyond that which would have been if they would have only done that entire activity in the United States. Because I'm paying a little bit more than 21%. That is the tax rate in the United States. We'll go through examples showing all this. So remember, excess FTCs, that's when I paid more foreign tax than the The limitation allows me to credit in the current year. I have excess foreign tax credits. That's a tax attribute. The tax rules allow me to carry it back 1 year, forward 10. That mechanic just means I take those excess foreign taxes and I put them in the FTC calculation for the prior year. If I have room in that limitation to utilize them, if I do, I amend that tax return in that year, file it, get a tax refund. If I can't have a carryback potential, then I look forward to the next 10 years. Doing the same calculation every year, but I just add these excess foreign tax credits into that calculation. If I am chronically limited, meaning the calculation in the prior year and the next 10 is always excess credits, I don't get to credit those taxes. That's double taxation on those foreign earnings. Okay? And that's where your effective tax rate, those of you that are in taxation of business entities, when we go through tax accounting, that's where you would get a hit to your effective tax rate. And that's where the ETR is going to go up. That's going to get the attention of the CFO. It's going to get the attention of the CEO. It's going to get the attention of the analyst market, depending on the magnitude of the number. Okay, let's do example 3.1. This is EFAN. Walk us through the facts and do case 1.
In case 1, the company ended up $100 for the foreign source income, and the first thing that happens is a foreign country tax rate. The foreign tax, so we know the foreign tax rate is 15%. So we can got on the $100, the company pays $15 for the foreign tax. Now, because this is a U.S. company, so we still need to consider the worldwide income tax. As 21% U.S. tax rate on this income would be the $21. But U.S. allow the foreign tax credit to avoid double taxation. The credit is limited to the U.S. tax on the foreign source income. In this case, it's $21. And since the foreign tax pay is only the $15, and that's below the limit, so the company uses the full $15 as a credit. So after the credit, the remaining U.S. tax is $21 minus $15 is $6. Therefore, the total tax on this income is still $21 and $15 paid to the foreign country and $6 paid to the U.S.
Very good, very good. So this is an example. The U.S. taxes worldwide income, so it's taxing all of this activity at one tax rate, right? Because it's a corporation, 21%. Effectively, what the U.S. is saying is the host country has primary right to tax this. So they get to collect whatever their tax rate is, which is 15. They get to collect that. And the U.S. says, but I think the tax rate for the worldwide income should be 21. So incrementally or residually, some people call it, I call it residual tax, you have to write a check to the U.S. government for the delta to get up to 21%. This is when the foreign tax credit works well. I do alleviate the double taxation on this, but I'm not capped at the host country tax rate. I get bumped up, topped up to the U.S. tax rate of 21. Okay, thank you. Okay, let's contrast that with case 2, Xinye. Anybody else need the sign-in sheet? Okay, so let me pause you there. So there's a key point in this variation in case 2. I still have the $100 of taxable income in the foreign country. Back to this picture, right? But what Janine just said is only $50 of the income, and I inserted considered foreign source income. Okay, so the host country is going to tax the income however they see fit, right? They're a sovereign country. They think $100 is earned in their country times 15%. I don't just take their word for it as to what I consider foreign source income. What we are going to go through today is all the sourcing rules for the income that's going to be at issue. The U.S. makes its own determination as to what is U.S. and non-U.S. We don't cede the right to the foreign country to tell us what is foreign income and what is not. And it's not geography. It's not geography. We're going to go income by income item, and the U.S. is going to tell us, is that U.S. or is it non-U.S.? So in this example, without showing you why, they're going to say, what if only $50 of this income is considered U.S. source income, or foreign source income under the U.S. tax rules? What happens to the tax? Okay. Yeah, so what's going on here, right? The host country doesn't change. $100 times 15%. We have this mechanic when we do the U.S. foreign tax credit limitation. It's going to limit us to what the U.S. considers to be foreign source, which in this hypothetical is only 50 times the U.S. tax rate. That is this calculation, net foreign source income times the U.S. tax rate. That is 10.5. But the U.S. wants to see $21 in tax paid. If they only give a credit for 10.5, the U.S. collects the other 10.5 to get you up to 21. So in the bubble here, I try to summarize all this for the key takeaways. So I got $15 of foreign tax that I pay, right? That's my host country. And I paid $10.50 to the United States. So my total tax went up to $25.50. That's more than this 21. So if these were two separate companies, who has the highest effective tax rate? Case 2, they got a 25.5% effective tax rate. This one's got a 20. Case 1 is a 21% effective tax rate. That's an example where the sourcing rules can hurt your ability to claim all of the foreign tax that you paid. And the other thing to take away from this is 4.5%, $4.5 of foreign tax that was not credited in the current year is now carried back 1 or 10. That's where tax accounting is saying, can I reduce my tax expense by proving that I can use it and carry back and carry forward? Okay. That makes sense? George?
So if there were more than one host countries, would you take the aggregate?
Yes. So when we get into the details in the foreign tax credit world, if there was, what George is posing is if there was another branch here that maybe is in a different country, had a different tax rate, do I get to average the two? And the answer is yes. I do the foreign tax credit limitation you'll find on 4 categories of income. What that means is I have 4 separate limitations, but within each category I get to combine a bunch of things. So I could have 2 branches, I could have 50 branches. You'll find out branch income is one of those categories, and I would average everything. And it's going to, you're going to have higher and lower tax rates, you're going to have bigger income, lower income, so it's all going to be different as to the way it works. But I do get a little bit of averaging, but within the category of the foreign tax credit limitation. Cover that a lot more when we get into foreign tax credits. Okay, so that's for US persons. Principally going to be doing sourcing of income and expenses for purposes of that FTC limitation to compute that multiple can in that limitation calculation. So why is this important for foreign persons? Sourcing also plays an important role for the taxation of foreign persons as they effectively define those two boundaries of US taxation of foreign persons that we've been talking about. The effectively connected business income for the foreign person. So remember, this is the US trade or business of the foreign person. So they're doing business in the United States. Remember, the United States only taxes their US activities of a non-US person. You don't have the right to tax what they do in another country, not a US person. Okay? So how do we tax that? We gotta look at the income, we gotta look at the expenses, what's US source, what's not US source. The net income lands on the tax return and is taxed at the appropriate tax rate. Corporation taxed at 21. So we have to compute that taxable income. The US also, the second area where the US taxes foreign persons is when they're not doing a US business, but they have invested in the United States. So think about investments in our equity markets where maybe part of the return, the investment returns is a dividend going from the United States to the foreign investors. If that return is US source, then we have to consider whether we have withholding tax in the United States on that outbound payment. Okay? If it's foreign source, the US doesn't tax it. It's the foreign person receiving it, receiving foreign source income when we go through the rules on income. So it's critical there, if you're advising that client, to know whether it's US source or foreign source. You got to make sure you got your income rules correct. Okay? So that's the two instances where it's important there. 3.3 is E-Link. We're doing the back road today. Please. Take us through 3.3.
Examples regarding a Norman Ray Allen non-resident. The scenario says Norman stayed in the U.S. for 3 months and made the $100,000 memorabilia from his hotel room in California. The key assumption is that the example assumes that the Norman's activity are frequent or substantial enough to constitute a trade or business with the U.S.
Yeah, so let me pause you there. So that's an important point. We haven't talked about that yet as to what level of activity causes you to have, quote, a U.S. business. This is assumed that they're doing enough of that, but they're going to be doing exactly what you were saying, which is regular, is it continuous, is it for an extended period of time? If it's one transaction done in one day, I think we'd all probably say that doesn't look like a business. But this is for 3 months, $100,000. Okay, well maybe that seems like it's more material, right? That level of activity, that level of time committed to it starts to make it look like a business in the United States. So let's assume that this selling activity creates a business in the United States.
So we check the tax classification because the income is divided from his U.S. business activities. It is classified as effectively connected income or ECI. So the conclusion is, unlike the investment income, which is usually subject to withholding tax, ECI is taxed on the net basis at marginal rate. It means Norman will pay tax on his income with the same graduated tax charges that apply to U.S. citizens.
Yes, and the reason there that's important is because NRA is a person, Norma Ray Allen. So that's going to be an individual doing business in the United States. What happens when a U.S. individual is doing business in the United States in their name? They're taxed at their graduated income tax rates as a part of their tax return filing. So this person would get to do an income statement, if you will, to determine that net amount of taxation. Sounds like we got $100,000 of income, but obviously there's expenses associated with that. If they're staying in a hotel, I would get to deduct my hotel stay. There's cost of the memorabilia, right? If it's an inventory type item, then I get to recover that. So it's not untaxed on the 100,000. 100,000 less some allocable expenses would give me to my net basis of taxation tax at the graduate. Okay, perfect. Thank you. Okay, 3.2. Did anybody volunteer for 3.2? I didn't look today. 3.2 was open. Anybody want to do 3.2? Super simple. Okay, I will do 3.2. Still cold. Okay. So in this instance, we're doing the second paradigm of how we tax foreign persons. And so Norma Ray Allen, a non-resident alien individual, owns 100 shares of USA Co., a U.S. corporation. So they're passively investing in the United States. They themselves are not doing the business. They just own stock of a company doing the business. If USA Co. pays a dividend of 100 to NRA, the $100 is U.S. source income and incurs U.S. withholding tax under the Internal Revenue Code. The reason you know that is because we'll talk in a few minutes. The sourcing rule for dividends is sourced to the location of the country of incorporation of the dividend-paying corporation. Right? So we simply look at, we don't look to the recipient. We say who paid the dividend. USA Co. Is USA Co. in a U.S. incorporated business? The answer is yes. That dividend is U.S. source. Okay? Meaning that we are now in the door of withholding. Now we got to determine the rate of withholding. That's a two-step process. The domestic law of the United States sets that rate at 30%. Remember I told you that if we have a tax treaty, the U.S. might negotiate that treaty with the other country. Something below 30%. It can go down to 0%. So that's where we'd have to get evidence of what country does NRA is it that person tax resident in. Is it UK? Is it Brazil? If it's Brazil, remember I said we don't have a tax treaty with Brazil, then NRA would get $70, $30 would be paid by USA Co. to the US government. If NRA was tax resident in the UK, I'm pretty sure the dividend withholding tax rate is 0 from the US to the UK under the tax treaty, then they would get the full $100 dividend. Okay? So it's a two-step process. First we have to source the dividend, then we determine the withholding tax rate if it's US source. If this were foreign source, then it wouldn't, there's no US tax. We have a foreign recipient of foreign sourcing. Okay? Okay. Income sourcing. So we're going to dive in now. We're going to go into the minutiae, item by item. Okay. So the sourcing rules are organized by type of income. Therefore, your first step in sourcing income is determining the type of income at issue. So don't get distracted about facts or anything like that. What is the income stream we are talking about? Hone in on that. Get that first, and then second, find your rule for that particular item of income. That's all you have to do. And you're going to do that for each item of income. You're building up this category here. So let's start off. We're going to talk about interest income. So if we get through all the facts and we say, okay, the item of income we're dealing with is interest. Interest income is sourced according to the residence of the payor of the interest, i.e. it is U.S. sourced if the debtor is a U.S. corporation or a U.S. resident, and it is non-U.S., i.e. foreign source, if the debtor is a foreign corporation or non-resident. Okay? So we just simply look at where is the debtor tax resident. That's going to tell you whether they're paying U.S. or non-U.S. So don't be distracted by factors other than residence of the payor, such as where the debt was incurred, where the documents were signed. Those are irrelevant in determining the source of the interest. Okay? You might think, oh, well, they went to the UK and negotiated this and they borrowed it from a UK bank. Doesn't matter. Black and white rule. What is the residence of the payor of the interest? U.S. source interest includes interest paid by the U.S. government. I would argue that probably the U.S. government is the world's biggest debtor. They pay the most interest around the world. There's other non-U.S. people who own U.S. Government bonds. So the U.S. those are outbound interest payments. Who's the residents of the payroll? Well, it's the U.S. government. It's U.S. Okay? U.S. source interest can also include interest paid by a foreign corporation engaged in a U.S. trade or business. So even though we have a foreign corporation paying the interest, we'll see a special rule whereas if that foreign corporation is deriving a lot of its income from the United States, then we kind of look through its foreign status to where its income comes from. And I think that makes sense. I'll go do that more when we get into that example. Just note there are exceptions to the general residence of the payor rule in cases of interest payments from branches and certain foreign subsidiaries of U.S. corporations. So the real world's not as clean as our textbook examples, so you can have some really quirky fact patterns. So just remember that if you're working on a place, and you got an interest sourcing question and it's a convoluted set of facts, make sure you read all of the rules on the sourcing of interest income, because if you have certain peculiar facts, you can also be caught up in that and that can change your analysis as well. That just goes to the point of when you're doing research, be very thorough. Read everything on the rule to make sure you don't get caught in an exception. Okay, let's do 3.5. 3.5 is Esmeralda.
This example is about a U.S. company called USA Co. that borrowed $10 million from a bank in the UK. The loan was made in London, but for this interest income, we use the residence of debtor rule, which means the source of the interest depends where the borrower is located, not where the bank is or where the loan happened. Since USA Co. is a U.S. corporation, it's going to be treated as a U.S. interest income. So the interest that USA Co. pays to the UK bank is treated as a U.S. source income. And then, so what matters is like who owes the money, so who owes the money, and the debtor is from the U.S., so the interest is.
Yeah, so this is just showing you not to be distracted by other facts. It doesn't matter what the loan is denominated in, right? You always, in advanced international, we're going to talk about foreign currency because transactions always have to be priced in some currency, right? So here, most likely is it's going to be in British pounds or it's going to be in US dollars. So the fact that it's in British pounds, the fact that they got it from a London bank, the fact that they went to London, signed all the contracts, it's just noise. Those are not the relevant facts for the purpose of this rule. Simply look at residence of the payor, it's US, so that's going to make it US source. We've answered the first question. Second question is that question of what rate of withholding do we have on that interest payment. Okay? That's going to be determined by statutory rate of 30, potentially less if we look at the tax treaty, which there will be a treaty between the US and the UK. Okay? And by the way, I think that rate is down to 0 as well in the US-UK treaty. Those treaties with the lowest rates are just probably more openness from a trade perspective. So we have very open terms relative to the UK and the history of the two countries. So you'll see a big reduction in the withholding tax rates.
I wanted to ask for a little bit of clarification. I'm not truly sure how that specifically works depending if you're from here or not, but if, for example, it's a non-resident but it meets the substantial residency test, like the 183 days,
Yep.
Does that put them as a U.S. source or
Yes.
still?
So great question. So let's say instead of this being a U.S. corporation, let's say this is a U.S. individual. So that's usually a circle depicted in pictures, but let's say that's a person.
And the question I think Rocio is posing is, what is that U.S. person U.S. resident or not? So if they're not a U.S. citizen, remember back a few class periods ago, we had two tests. We got green card, we got substantial presence. If they meet green card, they are a U.S. person. If they meet substantial presence, they are a U.S. person. So I would say if you meet the substantial presence test, then this is a U.S. source payment, even though that individual may not be a U.S. individual. Yes, George.
In relation to that question, so how about if the individual is actually your resident?
So they're a resident in a country that's a 0% withholding tax rate?
So maybe they're resident in Canada and they're also resident in the US. So you consider them, where would you?
The U.S. will say they're a U.S. Resident for tax purposes. So if you are dually resident, then you qualify for U.S. residency, you will be considered a U.S. person. Now, where that can be interesting is these tax treaties. So when I have a tax treaty between two countries, the front part of tax treaties, and we talk about this in more detail in advance, international, always has definitions up at the front of it, and one of them deals with dual citizenship. And usually what they have is a tiebreaker. So instead of instances where two countries claim you being tax resident, the countries would have agreed in writing in the treaty as to what is going to prevail over the other. So we assign residency to one of those countries. Usually what you're going to find in those is some subjective criteria about where the person lives. And now, I'm sure somebody could ask, well, what if they live in two places? What if they spend exactly half of their time in both locations? Where does their family live? Where do they get their mail delivered? Where do they vote? Those are the types of subjective criteria that you'll get to, and you'll end up one. It's not a 50-50 after you get through all those criteria. Usually there's one that outweighs the other. So that type of thing will, in a treaty setting, will be a tiebreaker. Good question. Okay? Okay, so that's interest, right? So you're going to commit that to memory or you're going to write it down. The residency of the payor of the interest or source for the incomes. Okay, on the dividend income is generally sourced according to the residence of the payor. Very similar to interest. So a U.S. source, if the dividend paying corporation is a U.S. corporation or U.S. resident, and foreign source, if the dividend paying corporation is a foreign corporation or a non-resident. Okay, so 3.6 is meta.
So in this example, we have a U.S. individual who is Uncle Sam, and Uncle Sam owns shares in a foreign corporation, which is Jericho. And basically, Jericho is paying a dividend to the U.S. individual, and like in interest, what matters is where the money is coming from, and it's coming from the foreign corporation, so it becomes foreign source income.
Yes, so again, we're going to just simple rule. We just look to the residency of the dividend paying corporation. So this is a U.S. recipient here. So the reason we're interested in this is probably for the foreign tax credit calculation of Uncle Sam in this example, right? Now you have a foreign company paying the dividend. So you're going to have German rules. We're going to operate independently of what we're talking about here, which is going to tell you whether you're subject to German withholding on this payment. And we do have a tax treaty between the United States and Germany, so whatever the German statutory rule is, there's going to be a treaty that probably lowers that withholding tax rate. Okay? So the reason the sourcing rule here, Germany's not going to care about that, right? Germany's a separate country. They're going to make their own determination as to whether they want to withhold. We're just sitting simply here. U.S. is probably going to, let's say they're subject to 10% withholding. They're going to get $90. They're going to have a $10 foreign tax. They're going to be trying to claim a foreign tax credit to offset their U.S. tax liability. This is important to say. Count this as foreign source income because that's the multiplication in the foreign tax credit limitation calculation. Right? Okay. A portion of dividends paid by a foreign corporation, this is that special rule I was talking about, can be U.S. sourced if during the prior 3 years, 25% or more of the foreign corporation's gross income was effectively connected with the conduct of a U.S. business. So this is not just stopping at the general rule, which is looking to the residence of the payor of the dividend, but we're going to look through to their earnings in certain instances when a large percentage of their earnings comes from the United States. So it effectively, the business creates a bunch of income, but a large portion of it's U.S. Think of it as when they then forward that after-tax earnings as a dividend, a portion of that dividend carries that U.S. source to it as an exception to the general rule. Okay, 3.7 is Sydney. Funny, we started there, now we're over here, moving around the room. Go ahead.
So in this example, Orco is a foreign corporation that earned 40% of its income from a U.S. branch, and because of that 25% look-through rule, since this exceeds that 25% threshold, 40% of the dividends that Orco pays are treated as a U.S. source, while the remaining 60%.
Yeah, so the way I would, I'm not a memory person, memorizing rules, I would just have come across these facts, I would say, wow, that's a lot. If I came across facts or I knew that foreign company here had a large U.S. operation, I'm like, I wonder if there's like a look-back rule or something like that. I might need to dig deeper to make sure there's not something like that here. So I put here in the bubble, this sourcing rule is only applicable to FTC limitations. Okay? What that means is, it's looking to see if one of these recipients of the dividend from Portco is U.S. taxpayer trying to claim a foreign tax credit. If all those taxpayers were non-U.S. taxpayers, non-U.S. tax residents, this rule has no applicability to them. Because this special sourcing rule only applies for foreign tax credit limitation purposes, not withholding tax purposes. We are not trying to subject Portco to U.S. withholding tax requirements for making a payment to a foreign person. We're just trying to say that for purposes of the recipients of that dividend, if any of them are trying to claim a U.S. foreign tax credit, then a portion of that dividend is not foreign source under the general rule, residence of the payor, but it's partially U.S. source. What is that going to do? That's going to lower that multiplication. Calculation I have in yellow. Okay. Anyway, yes, ma'am.
Does this also apply to, for example, if if it was like a big investment rather than just like a brand?
So if it was a big investment, so meaning like an investment into a U.S. corporation?
Yes.
Okay, so that's an important point. So if the U.S. branch were instead a U.S. corporation, which is signified by a box, then that income is not the income of Portco directly. So there's a subtle distinction here. When it's a branch, that income flows up to Portco directly, and you're paying a dividend out of that. But if instead it was replaced by just an investment in the U.S. subsidiary, that would not count towards this calculation, this special rule. Okay, our next bucket of income, personal services income. So income received in exchange for personal services is sourced based on the location of performance of these services. Okay, services performed in the U.S. result in U.S. source income. Services performed outside the United States, foreign source income. Think of personal services income as your salaries, your wages, any fee or commissions that are paid. But you're receiving it because you are doing something personal of your service. Okay? Under a de minimis rule, a non-resident alien can disregard otherwise U.S. source income, service income, which means they're doing something in the United States. If they are present in the U.S. for less than 90 days, receive no more than $3,000, I'll come back to that,
and are employed by a foreign business. Okay? This allows non-residents, so foreign people, to come into the United States on short business trips. They are performing services in the United States because they're in the United States on business without creating U.S. source income. Okay? You see the problem here. This is one of the rare numbers in the tax code that is not indexed for inflation. It's been $3,000 as long as I can remember. That's not a lot of money, right? If it's a foreign individual who's a very successful salesperson, and they come into the United States for a period of time, less than 90 days, that's 3 months, that income that's allocated there is going to be greater than $3,000, right? That person's going to make more than that over that period. So that's an unfortunate thing in the code when the U.S. puts in a rule and they don't index it for inflation. You get years down the road and you're like, well, that's an absurd number. It doesn't grow with prices grow, amounts grow. So unfortunately, it will stay at $3,000 until Congress goes in and changes the law. Fortunately, income tax treaties deal with this situation as well. So they do all kinds of things in tax treaties. They define dual citizenship, tiebreakers, which country are you in? They negotiate withholding tax rates like we've been talking about. They also deal with this situation as well because one of the things the countries will talk about is, oh, we want your people to come into our country for business. And vice versa, we want our people to go to your country for business. We're trying to foster business, right? So we will expand either the amount of time you can be in the country without it being considered a taxable presence, and we will increase the amount of compensation allocated that can fly under the amendments. Okay, so you'll see that they're much more reasonable numbers from a compensation standpoint in treaties. Okay, let's do an example here. An issue arises when the taxpayer receives a lump sum amount. So, like, if you start with a salary, you're going to get paid that salary no matter what you do for that company. And if you're splitting your time between countries, then we have to split that compensation between those countries, right? So it wouldn't surprise you that that's going to be on a time spent basis. But we have to deal with that as well. So let's do 3.8. That's your long.
So in this system, in most US citizens who receive $100,000 some annual salary for 150 working days, of which 25 days are spent working abroad. And because the compensation is on some service are performed both within and outside the United States, the income requires the apportionment between the US and foreign sources based on the related numbers of days working in the US.
Yeah, so this is saying I just simply allocate the 100,000 across time spent, but here I'd have to decide. The question's going to be this is a U.S. citizen, so now we're doing an outbound concept, and so the question is, what is going to happen in the foreign country? Is 25 working days a problem under foreign country law, i.e. subjecting T to taxation in that foreign country? And this allocation of the income between the two countries, is that enough? I don't know. It depends on what the foreign country law is. You could turn this on its head and have a non-US person doing this in the United States for 25 days. And then here we go back to, well, that's less than 90 days. Is it no more than $3,000? Well, here we just did the allocation. It's $10,000. So this person, if we switch the U.S. and foreign, then that person would be subject to U.S. tax on that U.S. source portion of the income. Okay, that makes sense. Place for services, it's always place of performance. Very much a host country rule. Where are you doing those things? That's where the compensation is. Okay. Okay. Alright, moving on, rental and royalty income. So you can see, we're just going down the income statement, all the different types of income that you can receive. And the one way to think about this is, you can think of this as an Excel file. I have a total line, which is all my income and all my expenses. And then I have column B, I can put as US, column C, non-US. I have to take each one of those things in column A and I have to put them in A, C, B or C. I'm computing the end of B and C is going to be my net income, column B and C. That's what I would do if I was an auditor. If I was an auditor, I would go in and I would make the company show me that they've done that. But then I know you've accounted for everything. Because again, it can't go to outer space. It goes in either column B or C. And I would make sure that you have applied the rules correctly to the items of income and expenses. Yes, sir.
Like before, so does it also apply if you are working remotely and just say, for example, okay, I want to live 1 month in the US?
So say again, sorry.
Let's say I'm working remote,
Yeah.
and I want to stay for a month in the US and do my work on the side, mainly and some other stuff on the side. Does it apply also to this?
Great question, great question. So what do we do with remote work? Where is the place of performance of remote work? I would argue the place of performance is where you are sitting when you're doing it, not on behalf of where the issue is that you're working on. Okay, so if you happen to be sitting in Canada working on a US issue, but you're working remotely in Canada, I would say that is not US source. Okay, now others could disagree with that. Some could argue like, no, it's where the location of the problem or the item you're working on. But I would take a very hard view of the rule, which is clear, it's place of performance. And I think place of performance is where you are sitting doing that work. Okay. As an analogy, this was a very big issue in St. Louis. Okay. So during the pandemic, you may know that within the city of St. Louis, there was a city earnings tax, which meant that 1% of every person's compensation in the city of St. Louis went to the city government. Well, when the pandemic happened, nobody was going into the office, right? Everybody's working from home, and most people do not live downtown. They live out in the suburbs in St. Louis, the area. So the question was, do you owe city earnings tax? I.e., where's the place of performance of your job? Is it you sitting in Chesterfield? Or is it because you're working for a company that is based in downtown St. Louis? And the city of St. Louis took the position that it was still downtown St. Louis city earnings tax apply, no matter where you sat. Taxpayers disagreed. One of the biggest law firms in downtown took the case, went to court, and won the case, arguing that no, place of performance is where you sit. So if you're sitting at your kitchen table in Chesterfield, that is not St. Louis and not subject to city earnings tax. Okay, so that's just an example of how it's a different concept because it's a local tax, but it's the same concept of where does remote work happen. Okay? But I think that's actually the right rule. And the law firm, I know the tax people that work there. That's a very good law firm, very smart tax people, and I thought they would win that case.
What if there's a blend of remote and in person? How would that, would it
So
be
then I
assigned a
think you gotta do
percentage?
this, and you gotta do kind of this allocation based on time. And so, again, I would be looking at, okay, remote, I think is where you're sitting when you're doing it, and you're logged in, you're doing that. And then if you're also doing some in-person, then that in-person is where is that being performed? So, great questions, and this is where it gets, the law is older, right? We didn't have a lot of remote work when this law was written. This law is probably 2 decades old, and everybody was going to this location. But now, obviously, we have a lot of people that work remotely. So, sometimes the business environment changes faster than the law does.
Want to know whether they will consider 1 year
personal service income, there's some bonus or allowance offers during the business trip, like someone working in the US, maybe half a year. So, and as a bonus on the ones maybe account for the large amount. So how to?
Yeah, I think, and so the question was, is there was a bonus or some kind of incentive compensation in addition to this? I think that would get allocated along with this as well. So I would think, as long as the bonus was for your activity for the full 12 months, I think you've got to account for it as being split between the two countries. Now, if the bonus was targeted directly because you did this, and that was, you could directly say that was when I did that outside the United States, then maybe you have a factual argument that it doesn't get spread amongst all this. But I think in reality, most bonuses are for a year's performance. And so I think it's got to get spread based on days. Okay. Next category, rental and royalty income. So rental income is tangible property, right? I've allowed somebody to use tangible property in exchange for a periodic fee over time. Royalty is the exact same thing, but with intangible property. So much more licensing of property that you can't touch. So a copyright, a formula, know-how, those types of things are licensed, but you still get paid periodically for the use and access to that thing. So same thing, rental and royalty income, very similar. So rental and royalty income is sourced to where the leased or licensed property is used. Okay. The lease license of property used in the United States gives rise to U.S. source income. Imagine leasing and licensing property for use outside the United States is foreign source income. Factors do not, again, get distracted by factors other than where leased and licensed property is used, such as where the property was produced, where the contract was negotiated, are irrelevant to the sourcing of this income. Right? Lots of facts around it. Just dig through them. What's important? Where is this property used? That's where I'm going to source the resulting income. 311 is She-How.
Okay, so in this scenario, we have a California production company produces a motion picture and then licenses that movie to use in the United Kingdom, and then also earns royalty from the presentation of the movie. So obviously we ask what type of income is this? It's a royalty type of income, obviously. So we apply the rules. The royalty income rule states that the source of the income is based on the location of the use of the license. So since in this example, it's used in UK, so it's going to be a foreign source income in this scenario. And then even though it's produced in the United States, because the rule also states that the production location is irrelevant.
Yeah, so don't get distracted again. Who's in the movie, who pays the actors and actresses in the movie, all that stuff's irrelevant. It's just, what is the income that we're dealing with here? It's a license, gives rise to a royalty. Look it up, look at my notes, or have it memorized. Oh yeah, royalties are place of use. Where is this thing being used? Being shown in UK theaters, right? So it retains itself as foreign source. Why is this important? Because I can guarantee you, California production company is trying to claim a foreign tax credit. Right? They might be getting hit with withholding tax coming out of the UK, with the UK law as to what they think about this. But if this is a company that is doing lots of foreign activities, they would be trying to claim a foreign tax credit. They would like to count foreign source income. Remember that multiplication in that yellow section? I want that thing as high as possible. If you're trying to claim a foreign tax credit, you want your foreign source income as high as possible because that's going to give you the highest limitation. Okay, the location for use of property may be both within and without the U.S., right? So it can be used, it can be moved around, you can use it in multiple locations. You must apportion the income based on time, mileage, or some other apportionment base. 312 is second.
So, Acme is a U.S. corporation, uses environmental testing equipment to manufacture for $50,000 per year. The key factor is that these use the equipment as plants located both in the United States and abroad. So, because the equipment is used in more than one location, Acme cannot treat all $50,000 as a U.S. source income. Instead, it has to split the rental income between U.S. source and foreign source. And so this will be done based on how much time the equipment is used in U.S. versus foreign.
So this is just, the item at issue can be moved, right? So this would probably be very common in US and Canada, so probably the further north you go in the US, somebody's taking equipment across the border multiple times. So you have to break into the lease payment and allocate it between the two countries, right? And up here, it just, you pick some kind of apportionment base. Obviously, days spent is a fair way to do it, but there's other metrics that you probably use to make that apportionment. Okay. Income from the disposition of real property. Again, I've run through these things. Gain from the sale of real property. So real property, right, is real estate and anything permanently affixed to it. Okay, so land, buildings, factories, warehouses, anything permanently affixed to it, that is going to be real property. So if I sell real property at a gain, that is sourced based on the location of the real property. I always remember this because just the idea that real property is unique, right? We don't typically make, I know there's exotic exceptions to this, but we don't make new real estate, right? Land is a finite resource. I know sometimes you see reports of some country trying to reclaim some land and build out onto the water or something. But typically land is a finite resource. Each country is going to treat their real estate as kind of like one of their jewel assets, right? Geopolitical disputes in the world about land, right? So land is very vital. So if I sell real estate in a country, that country is going to, that's the source of the gain, right? And I think that always, just because real estate is so prime, such a prime asset, that sourcing it to the location of that real estate makes sense. Okay? So factors other than the location of the real property, such as where the selling and negotiation takes place for the contract, irrelevant to the source. Do not get distracted by data. So I think I've exhausted the people I had listed. Anybody sign up for 313?
I was just asking a question.
Volunteering?
I mean, I was in.
Come on.
Alright, I guess I'll volunteer. Alright.
Be careful when you raise your hand.
I know.
Just make sure you put your name down.
Okay. Norman Ray Allen is a non-resident alien who owns Blackacre Estate, which is located in Music City, USA. Several years later, NRA sells Blackacre for a gain. Because Blackacre is located in the U.S., the gain on NRA's sale is U.S. source income.
So it's just black and white. Where is that real estate located? Doesn't matter if NRA met with the buyers in a foreign country, if the buyer is a foreign person, everything executed outside, it doesn't matter. This is U.S. real estate, it's always U.S. source. Okay? All right, what was your question?
No, I was gonna ask, like, on the single-family housing, how would that work now that, like, Trump banned it, that you can't, that, like, some of the REITs can't buy, like, single-family homes? Like,
Yeah,
how would
this
they
is
be on?
Great question. This is a very real thing, because this applies to individuals as well. So even though what Connor was referring to is that one of the Trump administration's initiatives for dealing with the affordability issue is to try to prevent corporations from owning single-family real estate homes, right? Because there are some corporations out there that have been gobbling up a bunch of single-family homes. And the idea is that artificially limits the inventory of homes, then inflating the prices, making what you guys will be encountering before too long, trying to buy a home a little more challenging. So be that as it may, you can still have foreign, non-U.S. individuals owning U.S. real estate. Okay? like a home. So I had this question from another professor not too long ago who had done time in the United States, obviously bought a house in the United States where they lived, and then they were going to go back home and start teaching abroad, and they needed to sell their U.S. real estate. So that was a question of, and real estate usually increases in value, especially if you hold it for long enough, and they had a gain in the sale, they made money. And the question was, how do they deal with that for their personal tax return? It is U.S. source, because it's U.S. real estate, right? My idea that it's a finite asset, U.S. is always going to assert that it's U.S. source. So the question is then how do they file that on their tax return? And so you can have individuals, you'll probably have, depending on if the, we have an administration that talks policy through social media, and it may not always be enacted into law. We'll see what that goes into law or not. You have to get the votes and pass that, but that's one's a little more popular, I think, across political parties. So if that comes in the case, we might have more inventory of real estate around there, but you have to have a transition of how do they force them to sell all that real estate that they have. So lots going to come about. Okay, I put in here in the bubble, note that U.S. real property can include stock of a corporation that holds a large amount of U.S. real estate. So this is where, when we're going through, the first question, remember, from the start of this section was, what type of income stream is it? And so that a lot of that is, what did I sell? Did I sell real estate or did I sell stock? So you could see if NRA was a wealthy individual and owned lots of U.S. real estate and was educated on U.S. tax and was well advised from a U.S. tax perspective, you could understand, well, this is problematic. Because if I want to exit real estate, I look at example 3.13, I'm going to have U.S. source gains all the time because I own a portfolio of U.S. real estate. Well, what you'll find out in a moment is if I own U.S. stock, when I sell stock at a gain, that is not U.S. source. That is sourced to the residence of the seller. So they might say, why don't I contribute all of this U.S. real estate into U.S. corporation? And then if I want to exit the investment, I can sell U.S. stock. We have a rule for that. That says if the assets of a U.S. corporation are vastly comprised of real estate, then I will treat that sale of stock as a sale of real estate for purposes of the sourcing of that gain, and I would take what would be foreign source and make it U.S. source. So it's kind of like a anti-abuse rule, if you will, by trying to move around between different rules of sourcing by changing the way you hold assets. U.S. is going to be aware that there's ways that you could try to mitigate those rules and try to frustrate that. So we call these U.S. real property holding companies, but it's a 50% test. So you might own stock in a U.S. corporation that's a business, a full-fledged, like say manufacturing business, that might own real estate, a factory, and a warehouse, amongst other things. But for 50% of its value to be comprised of real estate, that's a pretty healthy threshold. Because most businesses, their value is beyond their hard assets, right? It's their tangible assets. So I always think of this as either you're stuffing a lot of real estate into the corporation, or you just happen to be located in a very valuable piece of land. Like it's possible for a warehouse to be formed in a place that around it becomes very valuable, and it's like, okay, well, maybe that land is worth 50% of the business. Okay? But that's just an exception. Okay, here's a big category. Income from the disposition of personal property. So a couple things here. When we say personal property, contrast that to real property. Real property is real estate or anything personally affixed to it. Personal property is everything else. Okay, so it doesn't mean personal property like things that I own personally. It means desks, chairs, equipment, things that are not real estate. Right? So all those things, stocks, bonds, investments, all personal property. So it's not personal as like individual thing, it's just non-real estate is what we're talking about here. Gain from the sale of personal property is based on seller's residence. Gain from the sale of personal property by a U.S. resident is U.S. source. Gain on the sale of personal property by a non-resident is foreign source. Okay, so we look to the location of the seller. You can see here how these rules would be very convoluted to try to keep straight in your mind. That's why you got to write them down. Blast through all the different income streams. This one's even more challenging because there are numerous exceptions, which we're going to go through in the following slides, to the general seller's residence rule for certain types of personal property. Special rules for inventory, depreciable property, intangible property, and shares of a foreign subsidiary. So we have a general rule for personal property, seller's residence. Then we have to look at, well, what type of personal property is it? Is it inventory? I have special rules for inventory. Is it depreciable property? Property I have taken depreciation deductions on in the past. I have a special rule I have to go through there. So this is where it gets, again, a little bit more convoluted. And there are complex rules when a U.S. or foreign office is involved in the sale of personal property. So those rules can be implicated as well in real world fact patterns. Yes, Jerry?
What if there's like something like fixated to the real property, like trees or oil or something of that matter? Would that be?
That's a loaded question.
So, first of all, I'll take the second part. Natural resources is its own animal. Natural resources is very similar to land. Like every country thinks their natural resources is that's mine as a sovereign. So you're typically going to have that as being the source of the location, like real estate. If it's something not as valuable like that, and it's more like landscaping or trees or something along those lines, those are typically thought of as permanently affixed to the land. Think of like a parking lot or a parking garage. Those are permanently affixed, even though obviously you could tear up a flat parking lot and plant grass, but it's typically thought to be permanently affixed to that. So yeah, you'd have to just blast through all those types of little exceptions and make sure you've got exactly what is being sold. Okay, so we have a general rule, seller's residence. And then we have exceptions to that rule, so we have to make sure we really hone in on what is being sold. Okay, so let's do 314. Anybody sign up for it? Anybody want it? Come on out. You guys can sign up for this. That's why you don't know how hard it is for me to share a document with multiple people. My assistant and I are challenged by that. So you guys can go in there and sign up for this. Go ahead.
Citizen are revenue higher, sales allocating 100 shares change in your stock exchange. So US is a US corporation that does business operation only in the US. Tax gain is a foreign source income because I is a non-resident alien based on the general rule.
The general rule, seller's resident, right? Yeah. And so do not be distracted by it. You're selling US stock, you're selling Apple, you're selling whatever. Doesn't matter. Doesn't matter what stock exchange it's traded on. General rule here, seller's residence. This is extremely powerful, right? Because why is this important to Pat? Pat is a citizen and resident of Ireland. If this is U.S. source, they have to pay U.S. tax on this gain on this. And as you know, the stock market's done very well over the last 3 years. What if this is one of the high-flying stocks? NVIDIA that they've owned for the last 3 years. Massive gain. They have a large position in it. Deciding whether they're taxed in the United States or not by virtue of this rule is really important. Now, why would the U.S. not tax this by being, in my mind, very deferential in allowing this to be considered foreign source? The U.S. wants to encourage foreign investment in the United States. So, tax law is not drafted in a vacuum. The government also wants to think about the economy and what's best for everything. So they like foreign investment in the U.S. markets, right? The U.S. markets are the deepest and broadest and most liquid in the world. Part of that is because we encourage foreign investment in the United States. So this would be considered foreign source. So don't be distracted by the size. It doesn't matter if this is $1 billion gain. The rule is not premised on the size of the gain. Seller's residence. Now,
Ireland has its own view of this transaction. This person is a tax resident of Ireland. They may not be subject to US tax, but I bet they're taxed in Ireland on this gain. Ireland probably says we tax our citizens on capital gains. This is a capital gain. So it's not to say that they won't pay tax somewhere, it's just they're not paying tax in the United States on this, on our source of wealth. Okay, inventory is a very important area. So I want you to think in terms of inventory, two types of inventory. And it's based on how did you come to own the inventory, okay? You could purchase inventory. So this is, think of the big box retailers. They don't make anything, right? They just buy it, bring it into their stores, and then they resell it. Home Depot doesn't make, largely, I'm sure they make something at some point. They don't largely make any of their inventory. Manufacturers around the world make it, they buy it, and then they resell it, right? So that's what we would call purchased inventory. They acquired the inventory by purchasing it. They did not make the inventory. They did not manufacture the inventory. So, I have a general rule that says seller's residence, but if it's purchased inventory that I am selling, so how did you acquire the inventory? Purchased it, and then I'm ultimately going to sell inventory, right? So I've got income coming in from the sale of that inventory. What is the sale of that inventory? From a U.S. source or non-U.S. source? The rule here is for the sale of purchased inventory, inventory is purchased for resale is sourced based on where title passes. Title meaning the ownership of the inventory. Okay? If I go to Home Depot in Clayton and I buy something, when I'm at the cash register, when I give them my card and they give me the receipt, title has passed, meaning that I own the inventory when I get done with that transaction, right? Where did that happen? Obviously, the United States. Think about a large multinational that is exporting across the sea, right? They are selling, sometimes title passes in the foreign country. Why is that important? Well, typically, the party who owns the inventory until title passage is ensuring delivery or insuring with an E, maybe insuring with an I as well, meaning that they are paying for insurance coverage if something happens. If the ship goes down, who incurs the loss, who is doing all the logistical implications of moving the product, those types of things, which is very important where title transfers. For purposes of this, when I sell purchased inventory, I source that sale of inventory based on where title passes. So that's where, as the tax person, you got to go out and you got to talk to the people in the business, right? You got to go down to the shipping department. You got to talk to the legal people. It's like, what does the contract say? Where does title pass on this transaction? That's what's going to govern this sourcing of that. Yes.
So if there's a product that's like being developed in a bunch of different countries, like say like raw materials are coming from here, and then another subsidiary in a different company is like purchasing those raw materials, and then it's being purchased, they're developing a bit, and then it's being purchased again in a different country before like the final sale. Does that mean that it's being taxed, like that one product is being taxed in all of those points?
So this would, a great real world question, because right, the supply chain is much murkier than what I'm saying in the real world. So if things are bouncing around through a supply chain, then this is going to be the U.S. person and where they are involved in this transaction. So when did they purchase it? Did they purchase it? Did they not do anything to it? So like think Home Depot, it came in the back door and it gets sold going out the front door. If I sell that purchased inventory, then where does that title pass? That's what's going to govern that. So that's a great example of you could get lost in all the other mechanics of what's going on. But the question you first ask here is that inventory purchased or not? If it's purchased, then where does title pass when I sell that inventory? Okay? This is one where, remember that multiplication. We want foreign source income. If this is a U.S. company and we want the foreign tax credit as high as possible, we want the multiplication to be as high as possible. So we would want foreign source. This is where you can be a good tax planner, whereas you can work with the other parts of the business